Hi, it's John Kelly. In this module, we are going to discuss financial statement users and the ever-increasing galaxy of financial statement users. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, the issues are, of course, that the galaxy of financial statement users is expanding far beyond just the shareholders, who are the traditional user of financial statements, and the group to whom preparers and auditors owe a duty of care. And as users expand, then user needs become progressively harder to understand. Now, for financial statements, we kind of invented what I call a synthetic user, and the financial statement framework we use, standard setters said, well, here's what a synthetic standard normal user would want, and this is what the standards require to be disclosed to that user. For other users, it's much harder to understand what they may want because they may have individual and specific needs. Now, a modern list of users given to us by international standard setters includes bankers, financial analysts, those responsible for governance, stockbrokers, labor unions, tax authorities, and the list is longer. And my first reaction is, who the heck is missing from this list? And the answer is, of course, the shareholders, and they're getting more and more ignored by standard setters as they talk about who users are. And shareholders are, of course, the group that paid for the audit, and shareholders are the sort of synthetic user that up until now accounting standard setters have attempted to respond to as they defined what user needs were. Bankers and others, of course, want assurance for free, and who wouldn't? They did not pay for the preparation of the statements or for the audit, and to some extent they have undefined and unknown needs. In Canada, for instance, when bankers were surveyed, they had three completely different views of deferred taxes. A third of them looked at it as a liability, a third of them looked at it as equity, and a third of them just treated it as nothing. So with such different views of deferred taxes, it makes it very difficult for preparers or auditors to decide what bankers' needs might be if they have three such completely different views of what deferred taxes are. So therefore, it's hard to understand needs, and both the preparer of the statements and the auditor needs to understand the needs. If there is a sole shareholder, well, that's pretty simple for both the auditor and the preparer. We'll know of the needs of that sole shareholder. If there are many shareholders of a public company, for instance, we have the synthetic user that the accounting framework we use attempts to respond to by providing disclosure and rules for preparing the financial statements. If you have a known banker, well, the banker will have advised, hopefully, the preparer and perhaps the auditor of what it is specifically they need. For others, though, the international standard setters have suggested that the preparer have focus groups and listen to analyst questions and other such things. And gosh, that's difficult to do. And for the auditor, of course, that's even harder because it would be difficult for the auditor, for instance, to have a focus group about each of their clients, public company clients, to determine what that particular group wanted for that particular client. So that's very difficult for both the preparer and the auditor. Now, internationally, recently it seems to be in flux because there seems to be something of a change from the long list on slide 3 to determining that only lenders and shareholders are users of the financial statements. So we shall see how that plays out. In Canada, it's different again. Standard setters for private companies consider that the only user is the banker, and that the shareholders for a private company are not users of the financial statements to whom the auditor is responsible. So when the auditor and the preparer is faced with a decision about should more disclosure be provided, or following the disclosure initiative, can we get by with less disclosure, it's just confusing and fraught with great danger for both preparers and auditors. And despite the fact that international standard setters are advising us to get by with less disclosure and at the same time telling us to provide more disclosure, I think it's best for both preparers and auditors to err on the side of more disclosure. And particularly if you're preparing financial statements and puzzling about whether or not perhaps some additional disclosure should be provided, it's probably just best to do it. The other puzzling thing is that research shows that more, if only longer, disclosure is considered better by the markets. So, very difficult, puzzling, and changing situation for both preparers and auditors. So, thanks for listening.